Right now, an internal briefing note sits in a private folder labeled Distribution of Losses, Historical Case Studies. The subtitle is short and precise. 7 episodes where elites preserved capital and the middle strata absorbed the shock. On the first page, there is a simple pattern: early warning, asset rotation, balance sheet collapse, public rescue, quiet exit. Underneath, one sentence summarizes the logic. Those who move first convert claims into real assets. Those who move last hold the claims when the value is removed. The note does not frame this as a moral story. It frames it as a recurring structural outcome. In each case, late Rome, revolutionary France, Weimar Germany, Latin America in the debt crisis era, East and Southeast Asia in the late 1990s, the global financial crisis, and the COVID period, the formal shock looks different. Debasement, default, hyperinflation, currency crashes, banking panics, lockdowns, and emergency stimulus. But the internal sequence is similar. Access to information and instruments lets some groups rebalance out of the failing unit. Those without that access stay locked into wages, deposits, and small savings that lose value fastest. Part 1. Rome. Debasement and the retreat into land. The Roman section starts in the late Empire, when military costs, administrative overhead, and shrinking tax bases pushed the state toward repeated debasement. Silver content in coins fell over time. Prices rose in nominal terms, even as the real economy stagnated. For ordinary urban residents and soldiers paid in cash, the effect was straightforward. Their income came in devalued coin. Their ability to buy staples eroded. The note points out that senatorial families and provincial elites had a different position. Their wealth was concentrated in land, estates, and rents. As the coin lost value, they could adjust rents, extract payment in kind, and preserve a relative claim on output. Those close to power also had earlier visibility into tax changes, requisitions, and military campaigns. That allowed them to shift out of pure cash holdings faster. The middle strata, the small landholders, merchants, artisans dependent on cash trade, were squeezed between falling real incomes and rising nominal taxes and fees. They had neither the buffers of the top nor the political leverage to negotiate relief. Part 2. France, 1789, paper money and the exit into hard assets. The French case focuses on the years around the Revolution, especially the issuance of paper assignats. Initially backed by confiscated church lands, these notes were presented as a solution to fiscal crisis. For a time, they circulated alongside metal coins. As more were printed to cover ongoing deficits, their value fell. Wages and savings held in assignats lost purchasing power quickly. The briefing notes that segments of the old and new elite moved early into tangible assets. Some bought land directly when church and noble properties were auctioned. Others acquired claims on foreign currency, bullion, or movable goods that could cross borders if needed. When inflation accelerated, these positions held relative value. The urban middle, professionals, shopkeepers, small savers, often held a larger share of their wealth in the new paper, either by choice or because they had fewer channels to diversify. When the system collapsed into depreciation and then monetary reform, their claims were the ones most heavily diluted. Part 3. Weimar, hyperinflation, and the early flight from the mark. The Weimar section condenses a familiar story into distributional terms. As reparations, political violence, and economic dislocation hit, the state resorted to aggressive money creation. Prices spiraled up. Wages tried to chase them, often with delays. For workers and small business owners paid in marks, the ground moved under their feet. Cash lost value between payday and the market. Savings in bank accounts became almost meaningless in real terms. The note underlines how timing and instruments shaped outcomes. Industrialists, exporters, and those with access to credit could borrow in marks and invest in real assets, factories, equipment, foreign currency, that rose with or ahead of inflation. When the currency collapsed, their debts were wiped out in real terms, while their assets survived. Professionals without such access, along with pensioners and lower middle groups, saw fixed incomes and savings destroyed. Legally, everyone used the same money. Practically, some used it as a liability to be inflated away, others as an asset that melted. Part 4. Latin America in the 1980s. External debt, internal squeeze. The Latin America chapter focuses on the so-called lost decade. After a period of heavy borrowing in foreign currencies during the prior boom, a combination of higher global interest rates and weaker commodity prices made those debts unsustainable. Devaluations, restructurings, and inflation followed. Governments sought to stabilize by cutting spending, raising taxes, and tightening money. For elites with access to external accounts and advice, there were options. They could shift part of their wealth abroad, into dollars or foreign real estate. They could move capital into sectors with pricing power or into assets linked to export flows. When domestic currencies were devalued and local inflation surged, these positions buffered the shock. Middle-class households, by contrast, were concentrated in local currency salaries, small businesses, and domestic financial products. They bore the brunt of austerity, unemployment, and inflation. Their debts, such as mortgages, might be reduced in real terms, but many lost jobs or businesses before they could benefit. Part 5. Asia 1997. Currency pegs and unequal exits. The section on the Asian crisis looks at how rapid reversals in capital flows affected different layers of society. Before the crisis, many countries in the region pegged or managed their exchange rates against major currencies and attracted significant foreign capital. Corporates and banks borrowed in foreign units, often without fully hedging. When confidence broke, currencies fell sharply. Servicing external debt became far more expensive in local terms. Large business groups with international links sometimes managed to restructure, call on foreign partners, or shift assets ahead of the worst moves. Some relocated operations or listings. Investors with cross-border accounts could sell vulnerable assets sooner or move into foreign cash. Ordinary households and the domestic middle class met the shock through job losses, collapsing property values, and banking stress. Their ability to exit the local currency system was limited. They experienced the crisis through a fall in real income and net worth, not through a portfolio rotation. Part 6. 2008. Financial rescue and household damage. The global financial crisis. Chapter examines the asymmetry between how large financial institutions and ordinary households were treated. When major banks and insurers faced collapse, states and central banks provided liquidity, guarantees, and capital injections. The justification was systemic risk. Letting large nodes fail uncontrolled could have broken the payment system and credit channels. Equity holders and some creditors took losses, but the core structure was preserved. At the same time, many households in over-leveraged housing markets lost homes or saw long-term savings hit by job losses and market declines. They did not have direct access to central bank facilities. Their bailout, to the extent it existed, was indirect, stabilizing the system so the conditions did not worsen further. The note also points out that insiders in finance often had better information earlier. Some could reduce exposure to toxic assets or hedge against downside before the full scale of the crisis was visible to the general public. The middle class, relying on broad reassurance and delayed data, adjusted later. Part 7. The COVID era, asset inflation and unequal buffers. The COVID era section focuses on the combination of real economy shutdowns and very large monetary and fiscal responses. To prevent collapse, governments issued significant new debt and central banks expanded their balance sheets. Interest rates fell or stayed low. Asset purchase programs supported markets. For those who already held significant stocks of financial assets, equities, real estate, corporate claims, the recovery in valuations was rapid. In some cases, portfolios ended up higher than before the pandemic. For many in the middle and lower segments, the picture was more mixed. Emergency transfers and support programs offset part of the income loss, but small businesses that closed did not always reopen. Workers in less secure sectors faced permanent changes in demand. Those without large asset holdings benefited less from the rebound in prices. When inflation later picked up, it eroded the real value of cash balances and wages. The memo notes a familiar pattern. Interventions stabilized the system as a whole, but gains from the asset side of the recovery skewed toward those who owned more to begin with. Part 8. Shared mechanics across different centuries. In a synthetic section, the note strips away context and lists recurring mechanics. Early information access allows some actors to see stress building before it becomes public consensus. Access to instruments allows them to act on that information by selling claims, buying real assets, moving capital across borders, or restructuring liabilities. Institutional responses prioritize system stability. That often means supporting key financial nodes, which are more tightly linked to elite balance sheets than to median households. The units that fail and currencies, local bank deposits, unsecured savings, are disproportionately where the middle class keeps its safety nets. The memo is careful not to reduce everything to intent. It stresses that, in many episodes, officials and central banks genuinely tried to prevent broader damage. The pattern arises from structure. Those at the top are closer to decision points, have more diversified holdings, and can pay for advice on hedging and relocation. Those in the middle have fewer channels. Their main exposure is to their own labor income, local currency, and local housing. When systems are stressed, those are exactly the points where value is most volatile. Part 9. Hypotheses. Accident of structure or rational design. The authors lay out two clean hypotheses. One is that this repeated outcome is an accident of hierarchy. Any complex system will see those with more resources and information protect themselves more effectively in a shock. Under this view, the unequal impact of crises is unfortunate but not planned. The right response is better regulation, transparency, and social protection, so that future episodes share the losses more evenly. The other hypothesis is that, over time, elites internalize this pattern and build around it. Knowing that they can usually move first, they take more risk in the upswing and rely on the combination of central bank support and asset rotation to manage the downside. That does not require a meeting in a back room. It grows from experience. If this view is correct, then repeated rescues of the system without meaningful changes in who bears the cost may actually harden the pattern, not soften it. Part 10. The open question to the viewer. In its final pages, the note steps back from history and points at the present without naming a specific country. Debt levels are high. Asset prices in many sectors are elevated. The same channels of early information and flexible capital exist, and in some ways are more powerful than before. The middle strata, once again, hold most of their security in local currency income, basic pension promises, and primary residences. If another large adjustment comes, whether through inflation, restructuring, or a sharp market correction, the distributional question will surface again. The document does not tell the reader what will happen or what to do. It returns instead to the core pattern. 7 different times, in 7 different contexts, those with early access and real asset buffers managed to survive or even strengthen their position, while the middle absorbed disproportionate damage. The closing sentence is simple and deliberately unresolved. If the structure of information and access has only become more uneven since those episodes, what would you realistically expect to be different next time? And on what evidence would you base that expectation? One of the annexes in the note looks at how early signals travel through the system before a crisis becomes visible to the public. It points out that central bank minutes, internal risk reports at large banks, and confidential surveys often register stress months before headlines change tone. In those early stages, adjustments are quiet. Portfolios tilt gradually. Credit lines are shortened for specific sectors. Hedging activity rises. None of this is obvious to someone whose main interface with the system is a paycheck and a bank app. By the time broad media coverage catches up, many of the lowest risk exits have already been used. Another section breaks down the ladder of access in practical terms. At the top, there are actors who can move capital across borders at low cost, hold multiple currencies, and buy stakes in businesses, land, and infrastructure. One rung down, there are professionals and upper-middle households who may own some diversified financial assets, but still rely heavily on local conditions. Further down, there are those whose wealth is almost entirely in cash, small deposits, and perhaps a single home. The note makes a simple observation. When monetary regimes are stable, these differences matter less. When regimes shift, they matter a lot. The authors pay special attention to the role of housing because it is often the main asset of the middle strata. In some crises, such as high inflation episodes, the real value of mortgage debt can fall. That looks like a benefit, but the note stresses that this effect depends on being able to hold the property through the storm. Job loss, rising taxes, or spikes in interest rates can force sales at exactly the wrong time. Meanwhile, those with capital and liquidity can buy distressed assets. Over multiple cycles, this dynamic turns a nominally democratized asset class into another channel of upward redistribution. One part of the document examines how tax systems interact with crisis dynamics. In several historical cases, emergency fiscal measures were introduced after shocks to restore confidence or stabilize finances. These measures often took the form of consumption taxes, payroll levies, or broad-based cuts to public services. Such tools tend to fall more heavily on middle and lower income groups. At the same time, more complex forms of wealth, cross-border holdings, trusts, certain corporate structures, proved harder to reach quickly. The result was that the same crisis that wiped out part of the middle class's savings also justified policy changes that increased their ongoing burden. There is also a section on narratives and how they shape acceptance of outcomes. After each of the 7 episodes, public stories emerged about what happened and why. In some, the focus was on external enemies or abstract forces like the market. In others, blame was placed on particular political factions or on speculators in general. The note observes that very few of these narratives paid close attention to the mechanics of who moved when and with what tools. Without that focus, the structural pattern of unequal exit opportunities remained largely unchallenged in the public mind. The authors consider whether technology meaningfully changes this picture. On one hand, more people now have access to basic investing platforms, data, and commentary than at any previous time. In theory, that should narrow the information gap. On the other hand, the volume of noise has grown faster than the clarity of signal. High-quality early warnings are still more likely to be available to those who can pay for specialized research or who sit inside key institutions. Retail investors, despite better tools, often arrive late, chasing moves that are already underway. In a stress event, their ability to execute complex strategies is still limited by margin rules, product access, and time. Another annex looks at intergenerational effects. In several of the historical cases, middle-class cohorts impacted by crisis had fewer resources to pass on. Their children started from weaker positions, smaller inheritances, more debt, less stable employment. Meanwhile, families that managed to protect or grow their capital through the same episodes could consolidate holdings over multiple generations. The result was not just temporary inequality, but long-term divergence. The note does not quantify this precisely. It simply logs that, in archival records and modern data alike, shocks that look brief on a chart can imprint for decades in household balance sheets. The document then turns to potential counterexamples, instances where losses were shared more evenly. There are not many. A few post-war settlements spread costs through broad taxation, controlled inflation, and explicit write-downs of both public and private claims. In some cases, capital controls and targeted measures limited the ability of elites to move assets out ahead of adjustments. Even then, the report notes, influence and information still played a role. Those with better connections often found legal or informal ways to soften the impact. Perfect symmetry has been rare. The authors pose a practical question to policymakers without prescribing an answer. If the historical default is that elites burn last and the middle burns first, should deliberate mechanisms be built to change that? Options might include more progressive loss sharing and restructurings, automatic stabilizers that protect basic savings, or capital flow tools that slow down top-tier exits in emergencies. Each comes with costs: reduced flexibility, possible lower growth, and political resistance from powerful interests. The note does not endorse any particular design. It records that, so far, few systems have chosen to pay those costs up front. In its final pages, the briefing circles back to the individual level, as it has done in other sections. It acknowledges that most viewers will not sit in a position to change macro structures. They can, however, choose how they interpret assurances that this time is different when debt, inflation, or asset bubbles reach uncomfortable levels. The memo ends with a quiet reflection rather than a directive. If 7 very different societies across 2 millennia produced broadly similar patterns when stress hit, how likely is it that the next stress event will spontaneously invert that logic? And if you assume it will, are you basing that on new structures or mostly on hope?